Hi. In this final module on consolidation, we're going to look at unrealized profit in intercompany sale of depreciable assets. And I have an example for you here, so let's get started. On January 1, this is the parent company selling equipment to the subsidiary for $130,000. Note that the parent purchased this equipment June 30, year 2, and the sale is January 1, year 5. With a 10-year life and a $20,000 residual value, your first job is to calculate the carrying amount of the equipment at the time of sale. So take half a year depreciation in the year that the parent purchased this, year 2, and then a full year in year 3 and 4. So you might want to pause this video and calculate the carrying value of the equipment at the time of the sale and also the amount of intercompany profit. It's imperative that you do this correctly. Even though it's a very simple first-year accounting kind of problem, all the numbers on your financial statement around income tax expense, deferred income tax, equipment, and depreciation expense rely on you getting the correct number to begin with. So take a moment and figure this out, and on the next slide I'll go over this with you. Okay, with a 10-year life, this was $13,000 a year. The parent depreciated this $6,500 in year 2, and then 2 full years of $13,000. So our book value is $117,500. Deducting that from the intercompany selling price, we have a $12,500 gain. There's 7.5 years life remaining, so our subsidiary is going to depreciate this equipment at $14,667 per year. So you'll note that that's $1,667 a year more than the parent. And this is the amount of unrealized profit that we're going to realize every year through the use of the equipment. So, unlike inventory where you sell it to an external party and it's quite obvious that you earned this profit on an intercompany basis, you're probably going to keep the equipment and use it if you bought it from the parent. So, the realization is through the profit-making potential of that equipment. So as we use it, we realize the intercompany profit. Now, although the extra amount is $1,667 a year, the easy way to do this is to take the $12,500 intercompany gain, divide that directly by the 7.5 years of useful life remaining, and we get extra depreciation of $1,667 a year. And this would not have happened if the sale had never taken place. So you definitely will need to set up a table for this so that you can refer to the numbers in this table later when you do your calculation of consolidated net income, your income statement, and your balance sheet. So here's the original gain, tax on the gain, and net. And every year we're going to realize that extra depreciation amount of $1,667. Less tax is a net of $1,000. So there's the realization in year 5, a new balance, realization in year 6, and a December 31 balance. Now, in the year of the sale, you need to make 2 adjustments. The first adjustment is to eliminate the full intercompany gain, adjust your tax, and adjust your equipment amount. So this is a one-time adjustment that happens in the year of the sale. The next adjustment that you do happens every year until that equipment runs out of useful life or is resold, and that is to realize 1 year of gain. So let's look at the first adjustment, in the year of the sale, we're going to eliminate the whole gain to begin with. So the gain, of course, was $12,500, and if you were to look at the parent company individual financial statements, you would see that gain. So we're going to eliminate that, and we're also going to reduce tax expense. Similar to intercompany unrealized profit in inventory, on a consolidated basis, this tax was paid too soon. So we will recognize this tax as we recognize the gain. So there's a reduction in consolidated income of $7,500. Now, similarly on the balance sheet, we need to reduce our consolidated equipment amount by the full gain, and this $5,000 tax becomes a deferred tax asset of $5,000. And you'll notice that that actually equals also a $7,500 reduction in consolidated assets, matching your income reduction of $7,500. So in summary, on the income statement, this is what it's going to look like. Under probably other revenues and gains, parent plus sub minus $12,500, tax expense, parent plus sub minus $5,000. On the balance sheet, we'll have our equipment minus $12,500, and our deferred tax asset is $5,000. This first adjustment has eliminated everything to do with the initial intercompany unrealized gain. Now, the second adjustment, and the one you're going to do every year, is to recognize 1 year of the gain. So we know that the amount is $1,667 less tax of $667. So just as with inventory we reduced an expense account, cost of goods sold, we're going to do the same thing to realize 1 year of gain. We're going to reduce depreciation expense $1,667. Of course, reducing your expense increases consolidated income. We're also going to recognize the tax expense of $667, matching our revenue, so therefore the net effect on consolidated net income is to increase it $1,000. Now, on the balance sheet, note that the account that is related to depreciation expense is accumulated depreciation. We're going to reduce that account by $1,667. And you might need to pause for a moment and think of this. Make sure you take the time to understand this concept. If you reduce accumulated depreciation, you have actually increased the book value of your equipment. Make sure you do understand that concept. Our equipment is increasing by $1,667 a year, and of course I'm just talking about that one portion related to the intercompany sale. Now, we increased our tax expense $667, so we've actually used up that same amount of our deferred tax asset. So your deferred tax asset is going to go from $5,000, and it's going to subtract $667 every year for 7 years, and eventually be zero. So this is your yearly adjustment. Depreciation expense goes down, as does accumulated depreciation. Tax expense is increased, and we're essentially using that deferred tax asset, so it goes down. And you'll notice that the income statement adjustment ends with $1,000 more of consolidated income, and the balance sheet adjustment results in $1,000 more of consolidated assets. So if we put both of these together, and again, only in the year of sale, here's the reduction of the revenue, here's realization of 1 year's gain, here's the reduction of tax expense related to the original sale, and here's the recognition of 1 year of tax. On the balance sheet, our equipment goes down $12,500, but it goes up 1667 through a reduction in accumulated depreciation, and our deferred tax asset goes from 5,000 to an amount which is 667 less than that. Now, in year 6, to take this one step further, the adjustments are exactly like the income adjustment for year 5. So we just do the same thing again. And this is where it's very handy for you to have the table that I showed you earlier, because you can refer to that table to set up your calculation of income and your income statement and your balance sheet. So here's what your balance sheet is going to look like at the end of year 6. Your deferred tax asset continues to go down 667 a year. So from that initial 5,000, we have a reduction in year 5, we have a reduction in year 6 for a new balance. Your accumulated depreciation also continues to decrease by 1667 a year. So here's the year 5 reduction, here's the year 6 reduction, for a total of 3334. So in year 6, notice that we no longer need to eliminate the sale. We're only looking at 1 year of recognizing that previously unrecognized gain. So reduce your depreciation expense, that adds to net income. Recognize the tax that goes with it. The net is $1,000. But on the balance sheet, because these are not temporary accounts like the income statement, they're permanent accounts, that initial $12,500 deduction is still there, and your accumulated depreciation subtraction just gets larger by 1667 a year. So this number is 2 years worth on the balance sheet. Your deferred tax asset started at 5,000 and it's dropping 667 a year, so this number is 2 years later. And if you see equipment at net, you also need to be able to adjust for that. It's the same numbers, but if you put these together, here's the 12,500 deduction, add the 3334 that has been realized through a reduction in accumulated depreciation, so therefore the net amount is minus 9166. So that's it, and we'll see you in the next module.